Overview of the Philippine financial market. The financial system of a country is of immense importance as it portrays the stability as well as sustainability of the country. This highlights that the country's financial system acts like a mirror and a heart for its overall economic health. It reflects where the country stands today and whether it can maintain growth in the future. Here is how the financial system connects to each concept. Portraying stability can lead to confidence and safety. It also acts as a shock absorber, and it leads to investor trust. A stable financial system comprising reliable banks, stock markets, and regulatory bodies ensure that people's savings are safe and transactions happen smoothly. During economic crises like inflation spikes or market crashes, a strong financial framework absorbs the shock, preventing bank runs or total currency collapse. Foreign and domestic investors look at financial stability before risking their capital. High stability signals low default risk and political or economic predictability. Portraying sustainability means there's future growth, and this requires efficient capital allocation. A financial system directs funds from savers to productive channels. Users and suppliers can be individuals, businesses, institutions, and even the government. It also supports innovation. Startups and green initiatives require loans and venture capital. Sustainable financial systems fund forward thinking industries rather than dead end assets. Then we have debt management. It manages public and private debt levels to ensure current economic growth doesn't create a bubble that bankrupts future generations. So, why does this matter? When a financial system is fragile, even a wealthy country can face sudden collapse. Look at what happened to many countries during the 2008 global financial crisis. Conversely, a resilient financial system enables steady wealth creation, job growth, and long term national resilience. A country's financial system includes the banks, securities markets, pension and mutual funds, insurers, market infrastructures, and central bank, as well as its regulatory and supervisory authorities. These institutions and markets provide a framework for carrying out economic transactions and monetary policy and help channel savings into investment, thereby supporting economic growth. Here, we look at the financial system as made up of its core machinery, emphasizing that it is not a single entity but a web of interconnected moving parts. Each element mentioned plays a specific role in moving money from those who have it. As we have mentioned in the previous slide, we have our suppliers, they are our savers, or in some books, we refer to them as our investors, to those who need it. And in this discussion, you will see terms such as users, demanders, and borrowers. We are referring to the same group. So, how do these components work together? What is their role? We have financial institutions. They are the intermediaries that hold, manage, and distribute money. For example, we have banks. Then we have financial markets. We will be talking more about the different financial markets. Meanwhile, let us take let us take a look at the role of financial markets in this situation. They are considered as venues, physical or digital, where buyers and sellers trade financial assets. So, for example, we have your bond markets, we have our stock exchanges, then we have instruments or financial instruments. And these are referred to as formal contracts or assets that represent a monetary value or claim. Our examples include stocks, bonds, derivatives, and others. We also have services. This refer to the operations provided by institutions to help individuals and businesses manage money. An example would now be on payment processing, loans, and many others. We also have practices and transactions, and this refer to the rules, the standard procedures, and actual exchanges that keep the system running. An example of this would be interest rate settings and credit scoring methods. So, they're complex, they're closely interconnected, and what does this mean? The key emphasis is on interconnectedness. These parts do not operate in isolation. A bank creates a loan package, trades it on an exchange, offers payment handling, and settles the payment via interbank rules. That is how they are interconnected. The liberalization of financial markets in the 1990s and 2000s is considered to have contributed to the 2007-2008 global financial crisis. Let us not forget the important contribution of financial markets to economic development. In poor countries, investment, even in foreign direct investment, is costly. It is very expensive, which sometimes discourages investors to penetrate poor countries. But there is a solution to this. Well-developed financial markets may help fund such investment and in the process can help these poor countries be able to attract foreign direct investors, which later on will help their economy. To achieve this, financial markets require depth, access, efficiency, and stability. Financial depth refers to the total volume, scale, and availability of financial services relative to the size of the overall economy. Saying depth means institutions and markets are of sufficient size. Sufficient size signifies that the financial web is large enough to support a country's economic needs without creating bottlenecks or extreme volatility. Here is what sufficient size translates to in practice. When we say high capital capacity, banks and funds hold enough capital to finance large-scale projects like infrastructure, corporate expansion, and technology without relying excessively on emergency foreign aid or volatile international debt. There's market liquidity. Deep stock and bond markets handle massive buy or sell orders without causing drastic price collapses. In a shallow market, selling a large block of shares can crash prices. We will see more of this in Fin Management 4. In a deep market, there are enough buyers to absorb the transaction smoothly. Then we have product diversity. A large financial system supports a wide array of financial instruments such as long-term corporate bonds, venture capital, and complex insurance policies rather than offering only basic short-term savings accounts. A financial system with adequate depth acts as an efficient engine. It mobilizes idle savings from across the country and channels them toward productive, high growth opportunities. Then we have access. This measures how widely and easily individuals and businesses actually use available financial services. While depth refers to the size of the system, access focuses on reach and participation. Practical availability means having bank accounts, digital payment systems, credit options, and insurance policies actively available to the public. So, what is your observation here in the Philippines? Another is inclusivity, ensuring services reach low income households, small businesses, and rural populations rather than serving only large corporations or wealthy individuals. And we have overcoming barriers, removing obstacles to usage such as high transaction fees, long physical distances to branches, rigid documentation requirements, which, as you know, is a problem here in our country, or lack of financial literacy, which is also another challenge here in the Philippines. In short, a system has strong access when financial tools are not just available on paper but are actively used across all layers of society to make payments, save, borrow, and build wealth. And then we also have efficiency. This means that financial institutions are able to successfully intermediate financial resources and to facilitate transactions. Efficiency measures how cost effectively and speed consciously a financial system channels capital and settles payments. It breaks down into two primary roles. Number one, efficient financial intermediation, or what we call allocative efficiency. Institutions allocate or collect savings from depositors and direct them to the most productive borrowers at minimal operational cost. This is reflected in narrow interest rate spreads, meaning a small gap between what banks pay depositors and what they charge borrowers. Lower transaction fees and overhead costs mean capital moves to businesses and investors without much friction. The second one is facilitating transactions, or what we refer to as operational efficiency. Payment networks, clearing houses, and markets process daily exchanges like, for example, wire transfers, card transactions, and stock trades rapidly, safely, and at low cost. In short, an efficient financial system maximizes value by moving money smoothly from one point to another with as little wasted time, administrative friction, or expense as possible. Lastly, we have stability, which refers to low market volatility plus low institutional fragility. Financial stability means the financial system can absorb economic shocks, maintain public trust, and continue operating smoothly without triggering widespread crisis. It breaks down into two core conditions. The first one, low market volatility, meaning price and trading is calm. Asset prices do not swing wildly or crash without warning. Stable prices give investors, consumers, and businesses the predictability needed to make long-term financial plans. The second one is low institutional fragility, which means solvency and resilience. Banks, insurers, and investment firms are well capitalized, adequately regulated, and hold low levels of bad debt. When a firm is not fragile, unexpected losses or economic downturns won't lead to bank runs, insolvency, or systemic failure. In short, stability ensures that prices remain orderly and key financial players remain strong enough to keep credit moving even during tough economic times. Not surprisingly, high income countries have the most developed financial systems. High income countries generally possess the most developed financial systems because financial growth and national economic wealth reinforce each other. Higher national income creates substantial wealth and savings, which require advanced financial architecture to store, grow, and allocate efficiently. In turn, sophisticated financial systems attract foreign investment, fund technological innovation, and protect capital through strong regulatory institutions. So, what are examples? Okay, so we have enormous scale and depth for high income countries. They have massive capital markets with high liquidity relative to their gross domestic product or GDP, offering diverse financial products like, for example, derivatives, venture capital, and many others. The United States is an example. It is home to our NYSE and NASDAQ, representing over 40% of global stock market value, which allows companies to raise billions easily. Another example, like when it comes to universal access and digital integration, meaning nearly 100% of citizens hold bank accounts, credit cards, and instant digital payment tools. We have countries like Norway and Sweden where we consider them as nearly cashless economies. Imagine that. Over 98% of the population uses digital IDs and mobile instant payments. Another characteristic that we can look into would be institutional strength and stability, meaning they have transparent laws, they have independent central banks, and strict regulators that prevent systemic failure and enforce contracts. Two countries that I can give as an example would be Switzerland and Singapore. Both countries are known for hyper-stable central banking, sophisticated private wealth management, and highly transparent legal protection for investors. In contrast, developing nations often face financial shallowing, where cash remains the primary exchange medium, like here in our country. Stock markets are small or illiquid, and access to long-term business credit remains limited. A country's economic development relies on its local financial system to act as the engine, funding local businesses, providing personal credit, and turning domestic savings into investments. However, finance alone cannot create true economic progress. Again, finance alone cannot create true economic progress. It works alongside essential non financial factors. Why does economic development depend on the local financial system? It is because it helps mobilize capital. It channels local savings toward local entrepreneurs, infrastructure projects, and real estate. And it also finances small businesses. Local banks and micro lenders understand regional market risk better than foreign investors, thereby providing small businesses with essential seed money. Why does it not depend solely on local financial system? It is because of global financial access. So countries can bypass small local capital pools by tapping into foreign direct investment, international bond markets, or even foreign aid. Also, because of physical infrastructure, even unlimited credit won't produce growth if a country lacks reliable roads, ports, energy grids, which is again another problem here in the Philippines, and digital networks to move goods. We also have human capital innovation, which we can enjoy beyond our borders. Development requires an educated, healthy workforce, skilled labor, and technological advancement. Things money can fund, but financial institutions do not directly build. Lastly, we have governance and law. Clear property rights, political stability, low corruption, and enforceable contracts are essential for businesses to operate regardless of bank availability. Compared with purely domestic firms, multinational enterprise affiliates in theory are less likely to be credit constrained, make greater use of firm internal funds, make less use of external funds, and are less reliant on local financial institutions. Multinational enterprise affiliates enjoy a key structural advantage over local firms. That includes access to an internal capital market run by their global parent company. This internal network changes their financial behavior in several ways. Number one, less credit constrained. If a local banking system freezes or charges high interest rates, the firm can step in and inject cash, guaranteeing the affiliate rarely runs out of liquidity. Next, greater use of firm internal funds. Affiliates tap into cross border equity injections, retained corporate earnings, and intra firm loans, meaning borrowing money directly from the parent or sister subsidiaries in other countries. Another way is less use of external funds because intra-firm financing is typically cheaper, faster, and free of collateral requirements. M&E affiliates bypass external debt or local stock or bond issuances. And the last one is on less reliant on local financial institution. Purely domestic firms depend almost entirely on domestic banks and local capital markets. M&E affiliates can bypass underdeveloped or high-cost local banks altogether, instead raising funds globally through their parent company's international bank networks. Therefore, we would expect improvements in a host country's level of financial development to increase the use of funding from sources external to the firm, more so for domestic than for foreign owned firms. Recent empirical studies show both effects. Firms in developing countries benefited from improvements in domestic financial markets, and M&E affiliates have been less reliant on such improvements. This dual finding reflects the difference in how purely domestic companies and global firms source their capital. First effect, domestic firms benefit from local improvements. Purely local companies, especially small and medium sized enterprises, rely heavily on domestic banks and local stock markets when developing countries strengthen credit access, lower borrowing costs, or improve financial regulations. Domestic firms gain the capital needed to expand, invest, and innovate. The second effect, M&E affiliates rely less on local developments. Multinational affiliates have access to an internal capital market via their global parent companies. If a host country's domestic financial system is weak or underdeveloped, parent corporations inject direct equity, issue cross-border intra-firm loans, or secure credit from global financial markets. In short, local financial market growth acts as a vital growth engine for credit-constrained domestic firms, whereas M&E affiliates can bypass local market limitations by leveraging their parent company's international resources. Problems in financial systems not only disrupt financial intermediation, but they can also undermine the effectiveness of monetary policy, exacerbate economic downturns, trigger capital flight and exchange rate pressures, and create large fiscal costs related to rescuing troubled financial institutions. Moreover, with increasing connectivity among financial institutions and with tighter financial and trade linkages between and among countries, financial shocks in one jurisdiction can quickly spill across financial sectors and national borders. In short, when a country's financial system breaks down, the damage radiates far beyond banking halls into the broader macroeconomy. Here is how each problem mentioned in the statement unfolds. For example, on disrupting financial intermediation, when banks become insolvent or fear defaults, they stop lending. Savers cannot earn return on deposits, and businesses cannot secure working capital to maintain daily operations. Just imagine the effect of this later on. Another is on undermining monetary policy. Central banks have to adjust interest rates to control inflation or stimulate growth. However, if commercial banks are crippled by bad debts, cutting benchmark interest rates won't encourage them to lend, rendering central bank policy ineffective. Then we have exacerbating economic downturns. A lack of credit forces businesses to cut investments, freeze hiring, or lay off workers. Of course, they cannot borrow, they cannot expand, they cannot go on with their usual operations. And so it can lead now to all this cutting of investments, freezing of hiring, laying off of workers, and many others. And falling consumer demand further depresses economic output, turning a minor recession into a deep depression. We also have triggering capital flight and currency pressure. Panicked domestic and foreign investors pull their money out of the country to preserve capital as they sell the local currency to buy foreign reserves, like, let's say, for example, US dollars. The national currency rapidly depreciates, driving up inflation on imported goods. And then we have the creation of massive fiscal costs. Governments often step in as a last resort to prevent systemic collapse, funding taxpayer-backed bailouts, liquidity injections, and deposit guarantees dramatically swell public debt, diverting government revenue away from healthcare, education, and public infrastructure.